Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move to this speech this morning, and of course, the international economics personified by Adam Posen. He is leadership at the Peterson Institute, arguably the toughest act to follow in think tanks. He's done yeoman's duty there, and we're thrilled he could summarize all the academics at Peter Institute. Dr. Posen joins us this morning. You have the advantage of a shocking set of quality, Adam, in international economics. I see Warwick McKibben and Marcus Nolan, the giant Marcus Nolan, writing about tariffs. The Adam Posen summary, if we get a certain magnitude of tariff, what does it mean for our listeners and viewers?
Thanks, Tom. Thanks for monitoring our work. And the new piece by McKibben and Nolan is the latest best thing on what a tariff concentrated on China, Mexico, Canada would do. I think your viewers, your listeners should think about three sets of magnitudes. First is negotiating tool, small, for the most part, limited to a bunch of countries, but not all across the board. That's annoying, a burden on U.S. households, not a huge deal macroeconomically or market terms. The second level is what they're talking about, which is potentially putting on tariffs across the board at 10 or 15% across almost all countries, almost all industries. That's a genuine large tax increase, and it's a particularly distortionary tax increase. That's going to be meaningful inflation for American households, and it's going to be more like shortages felt in a lot of areas. So it's not just a question of what percentage of what part of the economy, and that's part of what the modeling we at Peterson and others are trying to do, is tease that out. That also is a world in which you get retaliation, almost certainly from China, Europe, Canada, Mexico, everybody. And that's a world in which everything shrinks. Sorry, third last version. Right. They overdo it, we get a recession.
I look at him at the work here, folks. I really want to emphasize the academics here of, say, William Klein at Peterson was foundational to moving away from President Trump's unilateral and bilateral, as Paul would say, transactional discussion. And William Klein said, we don't understand the multilateral ramifications of what we do. What would William Klein say, Adam Posen, about the multilateral impact of these tariffs?
Well, I hope you'll have Bill on soon. But the fact is, this is reversing 90 plus years of history in which the U.S. has, both as enforcer and as exemplar, said you don't get rich by closing your markets. And other countries have cheated, and it's mostly harmed them more than it's harmed the U.S., certainly, and more than it's harmed the rest of the world. But in general, we've gone to a world where for the last 25 years, the rest of the world keeps integrating and opening, even China. And the U.S. has been standing still on terms of integrating and opening. And so this now tips us backwards. And this is a world where things are going to be more expensive. Innovation is going to be less widely shared. Conflict and uncertainty for business investment is going to be up. And the developing countries of the world will be getting more shut out, except for the few very big ones like India and Brazil. And in the end, it's not going to serve any of the goals that President Trump claims he wants. It's not going to close the trade deficit. It's not going to weaken the dollar. It's not going to lead to better U.S. technology. It's not going to lead to more than a few 100,000 more manufacturing jobs at most. And it probably is going to lead to inflation.
Adam, given that backdrop here, what's your view of China these days? And given the challenges they face and given kind of some of the policies we're starting to see coming out of the Trump administration, how do you view China?
No, you're absolutely right. Again, in the same spirit of it's a general equilibrium, other people exist world. China's got deep, deep problems. And you and I started talking about this, 18, 20 months ago when I was writing Foreign Affairs, that China has economic long COVID. It's not just a real estate problem. It's not just that they're going through a short-term downturn. This is fundamentally about demographics and distrust of the government, and Xi pushing too far with intervention. Leaving aside what I know you've talked about in this program many times, the irony of the U.S. emulating China just as China is blowing itself up. The real issue is, does this make them more desperate to dump goods on the rest of the world if the U.S. shuts them out? Does this make them more desperate to pursue self-sufficiency, which will be a vicious cycle downwards for them, but also encourage the U.S. and others to shut up their markets? I think the bottom line is China, there's a lot of ruin in China, especially in a communist-run state, but they're not going to be growing anything like what they were growing at, and their moves towards so-called self-sufficiency are hurting them.
So, Adam, is globalism dead, or is it just kind of on pause here?
I think it was on pause. I think we're going through a setback, but it's not dead. One of the most important things about globalization, meaning not just trade, but the crossing of people, ideas, goods, investment, capital across borders, is it's always been with us. You go back thousands of years. In ancient China and ancient Rome, they were trading with each other. You go back hundreds of years, and even in the Middle Ages, even in the times of backwardness, there was a great amount of trade and interaction because the gains are so large, because people want variety, they want new ideas, they want entrepreneurship and possibility. I don't mean to get teary-eyed, but this is the reality. So nobody's going to kill globalization. What they are going to do is make things bad for them.
Adam, I actually traveled with this. I think I read a couple chapters at Jackson Hole. Doug Irwin and Maurice Obstfeld, floating exchange rates at 50. I got way too much peace, love, and dope on the show right now. Nobody's looking for Ecuador. Nobody's looking for Mexico. Do you and the team at Peterson feel, not to harp on 1998, but are we set out there for the headaches that Stanley Fischer faced in the 90s?
I think, Tom, it's good to be looking at these historical analogies, but I think we're set out there for the headaches that were faced in the 80s. That the U.S. gets so caught up in this mismatched macro policy of loose fiscal, belatedly tight money, and a huge upward dollar cycle that just continues. And that leads to debt crises around the world. Now, again, India, Brazil, possibly Mexico, depending on how badly Trump treats them, Indonesia, Turkey, now that it's getting its act together, the largest EM are actually going to do okay, especially in a world of geopolitics. But the rest of the developing world, almost all of Africa, South Asia outside of India, Central America, large parts of South America outside of Brazil, these are going to be suffering, as the IMF and the World Bank keep talking about, that there's huge amounts of debt that just keeps accumulating because there's not the growth, not the option. And as Ngozi, the WTO keeps talking about, open trade is the way to development for these countries, and the world shutting down.
Adam, one final question. Speaking of trade, do the Red Sox have a prayer? I mean, did they participate in the off season?
It's amazing, Tom. I know you keep track of the Bruins and everything. Watching the Celtics, watching the New England Patriots actually have a revival of hope, and seeing the Red Sox just sort of go, I don't get it. I don't get it.
Did you buy any Walker Buehler merch yet?
No, not yet.
Adam and I are on the same page on this. Dr. Posen, thank you so much. The gentleman from Brookline, Massachusetts, Adam Posen, of course, what a job at the Peterson Institute.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Ted Pick, just brilliant in Davos. Why was he brilliant? Because he reads Sarah Wolfe.
Of
That's
course,
why.
absolutely.
Sarah Wolfe joins us now. Mr. Pick starts every morning listening and reading his Thematic and Macro Investing team at Morgan Stanley as well. You're sitting having a beverage of your choice with Mr. Pick. What do you say about tariffs? Am I right that this is a study of magnitude more than anything else?
It's a study of magnitude, and it's a study of timing. If we look back to
the x-axis.
Yep. The x-axis, of course. If we look back to the 2018-2019 tariffs and you read the transcripts among the FOMC participants, they were broadly looking through the tariffs, right? That it was a one-off price effect, that it wasn't going to be inflationary over the longer run, and they were more worried about the following hit to growth after the tariffs. Can we do the same thing this time? Not necessarily. It's a little bit more complicated.
Why?
If we're phasing in tariffs over the course of this year, it's going to be a lot more difficult to discern the effects of tariffs versus the effects of, just real inflation. It's also going to be a price level increase that's occurring over a longer period of time than normal. So it's going to be more inflationary than what we saw back in 2018, 2019. And so the Fed might be in a position where they're going to have to take cuts off if that's the case, or not cut at all, and kind of be on hold until they see all the tariffs play out and what it means for economic activity.
So the Fed's really going to be looking at this tariff news coming out over the next several months?
Yeah, I mean, right now we were thinking that tariffs were going to be more of a back half of 2025 story and start to phase in. But as we heard from Trump in the last couple of days, February 1st, we could already be seeing tariffs on China, tariffs on Mexico and Canada. Mexico and Canada we're watching very closely. That could be pretty detrimental to U.S. manufacturing. Our auto supply chains are incredibly interlinked with Canada up in the north. Computers, electronics, all that type of manufacturing. And so not only is 80% of Mexico and Canadian trade with the U.S., but 20% of our trade is with them as well. So this is a bigger deal.
So on a game theory basis, down at Laredo, I've actually been there, folks, at the border, at the Windsor Bridge over to Detroit's where the horde comes over from Ontario to watch the Detroit Lions and the Detroit Tigers. On a game theory basis, they're going to respond. Then what do we do?
So I think this is all going to be a game leading up to the renegotiation of the USMCA, right, which is in 2026. And so if we put tariffs on Canada and Mexico, they retaliate and put tariffs on the U.S., and that's going to hurt U.S. economic activity. And then I think probably within 6 months to a year, we pull back the tariffs. And that helps the U.S. get some of the things that they want out of Canada and Mexico as we go into 2026 negotiations. So what does the U.S. want, right? They want Canada and Mexico to be stricter on immigration from their side of the border. They want the countries to be stricter on fentanyl, so drugs entering the U.S., and they want to be stricter on Chinese foreign direct investment that's filtering through Mexico and then back into the U.S.
So has all of this from the Trump administration, from the election, has it changed your view of kind of the economy, how to invest, where to invest? Has it changed your thematic view?
It definitely has. I mean, we're looking for more diversification. We think that valuations are a little bit bloated right now for the U.S., and there's some downside risk to economic activity. We should be looking to diversify possibly in Europe. There's some big policy changes happening in France, Germany, and the U.K. this year. We also are looking to emerging markets for opportunity. And so we do think that even though there is this story of U.S. exceptionalism, that things are a little bit too expensive here. The other thing we're looking at within U.S. stocks is to be selective. So the consumer, for example, which we talk a lot about on the show, internationally sourced consumer goods are going to have a tough year between a strong dollar, between tariffs. And so consumer services might be a nice place to hide again for 2025.
But Sarah, we're nowhere near job angst, are we? And your team, Seth Carpenter, Ellen Zentner, gaping in awe, until the job market breaks. It's a solid economy, right?
Yeah, there's nothing really concerning here in the claims data, right? Initial claims are basically low, moving sideways, which is reflecting that we're not seeing layoffs. Continued claims are trending higher, and we saw that in the report this morning, but that's just because we're not hiring as much. And so if I look at the totality of the data, labor demand seems to be solid and actually stabilizing. Into the fourth quarter, there was actually a reacceleration in labor income, and so that's really benefiting consumers and consumer spending, and that momentum is carrying through into 2025. I think the bigger question for this year, right, is labor supply, not labor demand, and that's the immigration story that we're watching very closely. Immigration was adding over 100,000 to payrolls the last 2 years, and so what does that mean for this year if we close down the border, if we have deportations? We're likely going to see a pretty sharp slowdown in payrolls because of losing that labor supply. What can that mean for wages? What can that mean for inflation? And then, as we all care about most, what does that mean for the Fed?
So given that backdrop, how do you expect the Fed to proceed this year? I mean, there's been, if you look at the warp function on the Bloomberg terminal, it's been all over the place over the past 6 to 9 months. Now I think we're pricing in maybe a couple of rate cuts this year, but again, people seem to be all over the place. How do you guys think that's going to play out?
I mean, we still think that the Fed's going to be able to deliver about 2 cuts. Of course, we're a little bit more focused on the risk of tariffs coming earlier and curbing that. So we're a bit more long duration than perhaps what markets are pricing in right now. Right now, they're right. There's a 50% chance for a second cut. We think that can move higher to fully price in
Really?
2
Wow.
cuts. Yeah, because, we're a little bit more optimistic that the inflationary effect is not going to be as aggressive and that there's going to be that negative growth effect from immigration and higher tariffs. Because right now we're seeing that consumers can't really take that much price.
I got to get this in. January flies by. We're getting near a February jobs report. Yesterday I saw a nice study of potential revisions by BLS. Model it in for us. How much does it bring it down?
Yeah, this is a huge catalyst. So probably it's going to revise down 2024 payrolls by about 86,000 a month. So bringing that number down to closer to 110 to 120,000 jobs a month.
Wow. That to me, that's a wow number. Am I wrong?
No, it's going to be significant. I think that more important is probably what we see on the household survey, though, because the payroll survey, the establishment survey is being pretty muddied by this immigration story.
Fair. Okay.
What you're seeing in the revisions is that they're benchmarking to the QCEW report, which tracks initial jobless claims.
Okay, I got 30 seconds left. I got to make some news. When do we hit 5% unemployment?
Not in our base case, and I think unemployment rate could actually
Not in your base case?
Not in our base case, not even in the bear case.
Entertaining. I mean,
No, listen, if we lose labor supply from immigration, that's down on the unemployment rate.
Yep, that's right. So how do we think about this here?
I so flunked that on the exam, Paul.
I know, exactly. I mean, I don't know. It's interesting. So we have to see how that plays through, Tom, with the labor market, because people have been telling us it's been the immigration has been a big part.
So are you going to give me a 3.9 on unemployment if we get major revisions, which
Yeah, I think for February, what we're going to want to be watching is what happens to the unemployment rate. We're going to get changes to the number of people unemployed, changes to the labor force because it's re-benchmarking to new immigration numbers. We just want to know how tight the labor market
This is great.
So we want the unemployment.
Sarah Wolfe, thank you so much with Morgan Stanley.
guys.
That was brilliant, folks.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Greg Peters, with his leadership in fixed income, leads the way. Greg, am I clipping a coupon or can I dream of total return?
Thanks, Tom. I think it's a little bit of both, but you talked about before I joined back to normal. This is what normal looks like. So I think what the expectation should be is clip the coupon, earn the yield, and this is what fixed income was ultimately designed for, right? The era of zero interest rates and hoping for total return is the abnormality. This is normal.
Bronze that.
Exactly.
Okay, Paul and I, as equity guys, are just saying bronze what he just said.
Exactly. So, Greg, in the fixed income market now, it feels like I've got some options here. I mean, I can sit in a 2-year treasury with the U.S. government, 4.3%, or I can think about taking some credit risk. Where are you guys these days?
Yeah, so, credit risk is a little more tricky. So the way I think about credit is that it's an affirmation of the growth story, meaning that credit spreads are quite tight, the richest decile that we've seen over the past, 30 years. And that basically reaffirms the strong macro, right? So the underlying economy is quite good. The corporate fundamentals equally as good. And so credit spreads reflect that. From an investing perspective, from our perspective at PGIM is, are you really getting paid for the risk and the uncertainty and if things do go awry? And the answer is not really. So we're quite cautious on the credit side. And it's not a statement of fundamentals. It's a statement around valuations.
So, Greg, for you guys at PGIM, did you change your outlook, your philosophy, your return expectations after the election? Did anything change for you one way or the other now with the new administration coming in?
Not decidedly. I think the story that gets lost in here is that, before the election, the economy was pretty strong. So this is a very different macro environment in Trump 2.0 versus 1.0, at least from a starting place. So no, not a lot has changed. What has changed, though, is the move away from the focus around central banks and the Fed and that policy, and more around the uncertainty of government policy. And if you put it all together, I do think it has had an effect on the markets, clearly.
Right.
But from a bond market perspective, I think it has, on the margin, pushed up yields because of the concern around inflationary effects and
Right.
then growth effects too. So, the
Right.
big move in the bond market hasn't been around inflation. It's been around real yields. I know you love that measure, Tom.
Yeah.
And real yields are up, almost 75 basis points from
Right.
the end of the third quarter. So it's been a real yield move, which comports really well to the equity story. So it's the re-rating of growth that you're seeing across the bond market and the equity market.
You can come on anytime. Greg Peters with us with PGIM. We will continue here. We welcome all of you on your commute. Huge response. College Station, Texas. Jess Benton with the fans.
She's a star down there.
Say good morning to all of you in Texas and, of course, on YouTube across the nation. After your commute, in your office, at home, YouTube, subscribe to Bloomberg Podcast. Greg, in my ute, a guy named John Templeton took me by my side. I was so honored. And he said in a Tennessee accent, Tom, there will be a shortage of bonds. I saw the French oat auction the other day and was flabbergasted at the interest. Greg Peters, is there a shortage of bills, notes, and bonds?
There is what we call the opposite of a shortage. So there's just a deluge. And that's what you're seeing across the globe, honestly, is that you're seeing this unrelenting supply of sovereign debt hitting the market. There's lots of chatter within the bond market around this notion of term premium, which is really, if you distill it, it is supply and demand. How much additional premium do investors require? And that's on the rise. And the reason why it's on the rise is because there is this legitimate and growing concern around the debt and deficit. And quite frankly, there's just so much supply hitting the global bond market that there has to be a repricing in term premium. So no, Sir John, we kind of have the opposite issue. The real question that we're pondering, and it doesn't seem to have any effect, is this potential crowding out effect, right? So the theory is there's just so much sovereign paper hitting the market that it crowds out corporate paper, but we haven't seen that either. So there's such a demand for fixed income securities globally that we haven't seen any sense of crowding out.
Greg, we hear a lot about U.S. exceptionalism as it relates to economic matters. How do you guys think about fixed income opportunities outside the United States?
Yeah, so I'm definitely been on this U.S. exceptionalism story. The opportunities this year are actually pretty broad, and so what's different about this year versus the previous few years, I think, is the dispersion, the disparity, and the various dislocations. So we're in a different macro than we were. So you're seeing different inflation regimes, you're seeing different growth regimes, and of course, as a response, different kind of central bank actions. So there's actually better opportunities to go global today than it's been in some time, right? So, the curves are priced differently. They should be priced differently. So, the opportunities in the UK relative to the US, relative to parts of the Eurozone at all is quite robust. It's just not one single market. It is truly a global market and I think there's alpha to be sourced there.
Greg, maybe a Robert Tripp or Tom Purcelli question, but I'll go to you on it. Do you stay up at night worried about the debt and the deficit, or do we have a growth rate that can sustain this madness?
I do worry about it. The scary part about the debt and deficit is that there's no magical number. There's no 150% debt to GDP, whatever you want to call it, and the markets wake up and say this is a problem.
Yeah.
And you're getting a whiff of it globally, right? You clearly got it from the mini budget crisis in the UK. You got it again in the UK in the fall. You're seeing it in France. So when you're in such an indebted society, these things matter. You just don't know when it matters. So I do believe that the risk on the table for the global markets, the U.S. market, is a debt and deficit. And so it's really important for policymakers to not ignore it. I know that's a double negative, but to focus on it, to say, hey, this does matter, because I do worry about the bond market taking over here. So I think this is the number one issue on the table going forward, and it just cannot be ignored.
So what are right now, where do you see just the best value in the marketplace, Greg? Because I know we've talked about, you mentioned credit spreads are so tight here. Where's value, if anywhere?
Yeah, so I do think it's back to normal, which is a carry market. So we're not looking for this fantastic full return type of marketplace. So it's about carry. And so we're building portfolios based on carry. And so we want to just own what we call kind of safe credit that just rolls down the curve, flip the coupon, not take a tremendous amount of credit risk, just because we don't think we're getting paid for it. Structured products is an area that really fits that bill well. And then, even though we're tactical, but if you kind of zoom out and think about what fixed income does in an overall asset allocation scheme, it is the protective measures, right? And so if the world does go pear-shaped, if things don't play out fundamentally as we think, having duration in a balanced portfolio is critically important and really helpful. So we really think there's scope for that in a balanced way. And so that's where we see the value.
Very cool. Greg, we're going to zoom in and note, we see this on YouTube, folks. Gregory Peters with Arsenal merch in the office. Yeah, Greg, do they have a chance of catching Liverpool here? What do you think?
I don't think so, Tom, but I think they're better positioned than the Tots, as you affectionately call them.
The Tots are on the edge of relegation. Get out. They call, did you know, Paul, they call the standings the tables?
The tables?
The tables, as if you're informed. You look at the NFL tables or that. The Tots are on the edge of relegation. It's an outrage to say the least. Greg Peters, thank you, with PGIM. I learned a lot there. That was really wonderful.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
I say good morning to you. And of course, front pages, it's the Lisa Mateo Hour. Lisa, what do you have this morning?
All right, this one actually is some good news. So a new study says college enrollment rebounded since the pandemic. This was a study, the National Student Clearinghouse Research Center. So the data says undergraduate enrollment neared 16 million in the fall of 2024. But this really stood out. Freshman headcounts grew 5.5%. A big part of that enrollment of students over the age of 21. So not sure if those who were putting it off are now going back. And then the traditional freshmen that come right out of high school, a lot of them, the biggest rate were from students from low-income neighborhoods, particularly community colleges. But what really stands out to me is this is the time where that FAFSA form was such a headache. It was such a nightmare for parents. And despite all that, the college enrollment is still going up.
And because it comes at a time when people really are questioning the value of a college education, given the cost. Is it worth the debt that a lot of kids have to take on to get that degree? Is it better to go to a trade school or to do some other path?
Or the community college route.
Community college route, exactly.
I don't look at Reddit too much, but the little bit of the Reddit feed that comes in to my email feed, the angst of kids having to pay these tuitions, $60, 70, 90,000 a year.
Yep.
Sometimes it's out of control.
It is.
It's
And there's
breaking.
there's a article in the terminal too, if you look it up, that says financial aid is increasing.
Oh, yep.
So hopefully that's going to help. But my daughter's on the college hunt. We've been to open houses and they are packed. Like the officials, the administrators are saying this is like some of the highest rates they've seen at open
post-COVID
houses.
thing.
It is.
Yeah, I
It
think
is
right.
exactly.
Maybe some
Next.
kids took some time off.
Okay, this is also a post-COVID thing. The Wall Street Journal has this article here. The screens are taking over classrooms, right? Kindergarten through high school. But educators are starting to wonder and question if this is really helping or hurting kids' learning. So there's a debate, right? The teachers saying that they help create more engaging lessons. But then you have others are saying it's distracting. It's burning out teachers because now teachers have to find a way from stopping students playing the online games and watching videos in between when they're in the classroom. So they're saying it's distraction. Parents are trying to take their kids, opt out of technology. Some students are just tired of it in general. So it just shows this debate.
Do you think you learn the same? Do you think, like I have trouble taking an exam on the screen. I flunked the last 30 Bloomberg exams, but do you think you retain as much off an iPad? I don't think so.
I think when I write, I retain it better.
That's my
Yes,
view.
I totally agree with that. And I keep trying to, tell my daughter, like, she's still doing the flashcards and writing it out. And, because I feel like it helps you remember it a lot better than
For
just
each company I covered on Wall Street for 30 years, I had a notebook for each company for all my notes, for all the earnings releases.
See?
So I had like 50 notebooks for Disney, 50 notebooks for... And all my notes were there, and I felt like when you wrote it down, but that's just me. Maybe
Can we do a 5-second audible?
Yep.
Yes.
Afterthought just got our best report card.
Oh,
Nice.
good.
She
Okay.
passed Jim.
There you go.
No Chromebook
There
needed.
is hope.
Yes.
Continue.
And this one I found interesting because remember Tuesday when Larry Ellison, co-founder of Oracle, shared the stage of White House President Trump, they announced that Stargate deal. Well, now sources are telling the New York Post that backing, it could save his son David Skydance Media to gain that approval that it needs to merge with Paramount. They're saying maybe that's some of the reason behind it. Paramount also considering settling a $10 billion lawsuit President Trump filed against the company over bias ahead of the merger. So that kind of stood out when he stood up there.
Yeah, there's no regulatory problem for Skydance buying Paramount, but to the extent that there's any litigation out there, maybe currying favor with the president's not the worst thing. We've seen it time and again.
Lisa Mateo, thank you so much on the newspapers. Thank you.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.